Good morning, everyone. How's it going? It is December 18th, Monday. It is the second to last week of the entire year, and we are entering into what is usually the very most quiet period of time in the markets the entire year. So we want to be very careful about how we look at things, evaluate things. The smart thing to do might be to just sit out, have some fun, enjoy yourself, enjoy your family, or even reflect on your trades, go back through the trades that you've done throughout the year, your performance, do a little bit of studying, get ready for the next year. But if that's not your desire and you want to continue trading these markets, then we want to evaluate things very, very carefully. So let's take a look at how we're opening the week. In the futures, we've got what looks like about 33, about a third of a basis point on the S&P 500. So we are starting to get into somewhat significant territory or outside of random. In the NASDAQ and Dow, we are still in the random territory. So there is a little bit of a positive bias. This market just doesn't want to give up. It just wants to keep on going. It does look like that Santa Claus rally just actually from November all the way until now, it's been in effect. We are in dangerous territory in terms of a pullback, but again, we in this market we have to trade the market that we have and we have to go with the trend that we have. So we are still in an uptrending market. It is getting extreme, but we don't want to front run ourselves. So we want to start getting more and more cautious the higher and higher we go. And if we look at the S&P last week, on Friday actually did come down. That is a downward movement. And our pre-market movement just brings us right back up to our purple resistance line right here. So it could do what it did last week, which was kind of peak out right here and go sideways or start moving downwards. The opening doesn't tell us anything other than it's opening higher, and then we've got about a 70% chance of it start moving towards the previous close. So if we opened higher, that would be downwards. It doesn't mean we'll end down. It just means that sometime during that day, we're going to start moving downwards pretty close to the previous close. If I want to see how the next week is going to go, then I look at several days of data. I can look at a few weeks. So if I want to know, for example, how tomorrow is going to go, then I'm going to study the previous day very carefully. And then I'm going to study the few days before that as well. So, for example, when we were over here, and I have this day right here, and then when we opened over here, we opened below and we started to trade higher, and we significantly broke above the previous day high. That gave me a clue that we were having upward momentum, but we had to go many days in order to know that there was resistance here. And it did react to that resistance, but not for long. And then it just broke right through it. So that upward momentum did carry over. So if I want to know how this week is going to go, then I do the same thing, except I do it on a weekly chart. So if I want to have a clue of how this week might go, then I see that we had this very strong upward movement over the past few weeks, kind of petered out over here, but we got another strong surge this last week. This tells me that there's no indication here yet that we have a slowdown on a weekly basis. So, and I did get really strong volume last week compared to the previous weeks, and that was a pretty big bar upward. So that's upward momentum. So this week, my expectation, if it wasn't a super quiet week, would be that perhaps that upward momentum would continue. And it looks like we are opening. We're opening right here, so that my open is already in the upper range of the previous week. So the important levels for me to look at will be the high of the previous week and the close of the previous week. I'm pretty much going to rule out the open and the low, which look like they're pretty much the same. So the close of the previous week, 469.28, and the high, 473.62. I don't know if I'm going to remember that. Let me get those in. So we've got 469.28. Let me get a line in there. Okay. And then this was the previous week close. And then we had 479, 473.62. Okay. And another thing that I'm going to look at is the last 5 days of range. And you can see that somehow I missed. So there was a lower low. So I probably just wasn't precise enough in my line right here when I tried to find that open. Oh no, that was the previous week open. So I shouldn't move that line. So I also want to know in the last 5 days where we traded, and actually 1, 2, 3, 4, 5. Okay, so this is going to be important level as well. That's important level. And then I'm going to get rid of some of these clutter lines since we are pretty far away from these ranges. I want to know the previous day, that low. Put that in purple. I can get rid of this one. This level seems to be reacting. This level is reacting. And then let's get in a couple lines from our pre-market. Well, just the one line. So these are going to be important levels for us. The ones that are in this kind of sea green color, they're going to be relevant all week. Actually, this purple one's going to be relevant all week also. These other purple ones are going to be relevant for today, but not necessarily the entire week. Okay. So my expectation, because we are entering the quiet period for the year, is I really should expect chop. Unless we get really strong momentum and a strong breakout levels, then we really should expect it to chop. So we should stay within these lines. And if we break out of these lines, then that is very significant. So for example, if I break below this sea green line, I still have this one to catch me. But if we go below that, that's really significant this week. And we can expect the market to get really directional. If I break above this high right here, then that is really significant. And I can expect it to start trending towards this all-time high. But anything other than that, that's just random. It's just going to be random movement. And that's pretty much our expectation for the week. What that means is it's going to be difficult to gain any momentum or gain any profit on directional trades. So if I just buy a call or buy a put, it's going to be difficult for me to generate profit. So I have to be very judicious about the calls and the puts that I decide to buy. Now, if I decide that I want to do a non-directional trade or I want to do an income style trade, that carries a lot of risk because we are at these extreme highs. And two things happen at extreme highs. For example, at a 52-week high, that's actually very bullish and there's a tendency to keep on going. But we are also hitting very strong resistance levels or nearing very strong resistance levels. And in this case, that's it's not, I don't want to call it bearish, but there is a pullback potential. So those both of those could cause actually pretty high directional movement. And right now in my market, I have very low volatility. Right? My VIX is very low. It's basically pre-COVID levels. So if I look at my ATR, you can see that my ATR is at the bottom of this range. There's a huge high right here, and then over here I'm at these lows. Maybe I should zoom in. Yeah, see where I'm at these lows, which means that if we start moving, my ATR starts increasing. And if I base my levels on the current volatility, then there's a potential for me to break through those levels, which means I lose a lot of money because in neutral trades, in in verticals and iron condors, if we use them as neutral trades, then the reward to risk ratio is terrible. I might lose, I might make only 10% for the week, which means I have a 9 to 1, actually a 1 to 9 reward risk ratio, which is really, really bad. That means I can lose a whole bunch of money and make only a little bit of money for the risk that I'm taking. And with my ATRs and my IVs so low, the risk that I'm taking is really big, actually. So it, we definitely do not want to go into direction, or I'm sorry, neutral trades because the potential for us to just get whipped out of them and lose a large amount versus the amount that we could have won is very, very high. So we don't want to do those neutral trades. We have to be careful about our directional trades because it looks like we're not going to get a lot of direction in the next week. So that was why at the very beginning I was saying it might be a good idea to just sit on the sidelines. Now, again, if you want to trade and not sit on the sidelines, then what we have to do is pick very, very, very carefully the stocks that we go into and that we choose to buy options on. So your best strategy in this case is to remain somewhat delta neutral. And what that means is if I buy a long, I'm going to buy a short. And if I buy a long, it's going to be in the strongest stocks and strongest sectors. And if I buy a short, it's going to be in the weakest stock in the weakest sectors. And that way, if there is a breakout directional movement, the weakest ones should fall a lot, or if we get a break to the downside, the weakest one should fall a lot faster than the strong one. And the strong one should go up a lot faster than the weak one if we break up to the upside. And in this way, you start out delta neutral. So if there's random movement, they balance each other out. But if there's highly directional movement, one gains a lot faster than the other one loses. So what we would have to do is we have to go in here and take a look at our sectors and just decide which ones are strong to the market and which ones are weak to the market. Remember, well, I guess we could go right here. There should be SPY in here. Let's look at a list as a table first. So we've got the S&P somewhere in here, right here. So you can just immediately look and see that, okay, well, these are the ones that are weak to the market, and these are the ones that are strong to the market, at least in terms of a 1, 3, and 6 month average. So the average over the last 6 months, 3 months, and 1 month. Do we want to look a little bit shorter term than that? Maybe. So if we do that, so maybe over the last 3 months or 2 months, since we got that really directional movement only in the last 2 months. So I might want to look at it in terms of the last 2 months, and we can see SPY is still down here. And so there's not that many that are weak to the market, and there's a lot that are strong to the market on that 2 month basis. So I'd be really interested in taking a look at the graphs of XLU, P, C is a little surprising, V and E. And then the ones, these are interest rate sensitive. So what we notice is that TLT has been screaming higher, meaning that yields are going lower. And if the yields are going lower, anything that gives a yield relative to the interest rate we're going to outperform. So, home builders, semiconductors, real estate, very interest rate sensitive, technology, very interest rate sensitive. So they've been outperforming the S&P 500 by quite a bit because of that TLT movement. You can see that bonds are here at the very top. So this should be the normal bond, not the triple. So if this wasn't 3x, it may not be at the very top, it may be near the top. But in any case, bonds are somewhere at the top. And so I'm going to be very interested in looking at XHB, retail, XRE, semiconductors, and technology on the upside. So UPCVE on the downside. Let's look at those first. And I would want to see, so U try to break above the MA50 and then came crashing down on Friday. That's a significant gap down in XLU. XLP looks very similar. It touched the MA50 and then it broke down towards the lows. So these are very good candidates to look for shorts in XLU and XLP. XLC looks like it's still in an uptrend, so I'd avoid that. XLV, same thing as XLU, except a little bit stronger because it moved up so high and it gapped down to this EMA 8. Yeah, EMA 8. So that's still in an uptrend, technically, even though there was a gap down, a big gap down because of this huge white bar right here. So XLU and XLP still look like a better bet. And XLE looks very, very, very weak. It did start to move up. It bumped into this MA50 right here and then kind of went sideways. So I would be looking, but energies are a little bit more commoditized. So I'd really be looking towards utilities and staples for my shorts. And then for the longs, I'll go to the very top and XHB, we've got that pause, sideways pause, XRT sideways pause, SMH actually continue to move up a little bit. So right now, and XLK also continue to move up a little bit. So those two look like the best bets on the way up. And if I want to be more specific, because SMH would be a subcategory of XLK, then I would stick to the SMH. So I would, for this week, I'd be looking for a long inside of SMH and then a short in either XLU or XLP. If I wanted to do two longs in SMH or within the SMH sector, or maybe one within SMH, but one in tech, but not in semiconductors, then I would choose one in utilities and one in staples. And then just see if there's a breakout in either of those. And so that I could potentially make some non-random amount of profits this week. Because if it's just a random amount of profits, it's not going to be meaningful unless I just say, oh, it's randomly went up. Let me lock that in really fast. But it can randomly go down as well. So my best bet is to go for the best performing semiconductors, the best performing tech that is not a semiconductor, and then the worst performing utility and worst performing staple. So that's how I'm looking at it for this week. I am going to be personally, I'm still going to trade. So I am going to be looking exactly in these sectors for hopefully breakout movements sometime during this week. If the market chops sideways, they still have the potential to break out. If the market breaks out, then for sure those sectors, I can't say for sure, but very, 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 very high chance that one of those sectors will break out as well. So either to the downside in UNP or to the upside in XLK and the semiconductors. So other than that, if you're day trading, be careful because volume is going to be lighter, not going to be as many day traders, and there's not going to be as many opportunities. And there is a high potential, just like we saw last week, for a lot of these sudden reversals, so bear traps and bull traps. So just watch out for that. So same as always, you parse out your day, first hour and last hour and everything in between. Okay. So that's all I've got for today. Hopefully, you will decide either that you're going to stay out of the market and then just study, or stay out of the market and enjoy your family and enjoy your time off, or you will, if you're going to trade, then just be very, very judicious about the trades that you take. And don't This is not a week where I would take my full risk allocation, because there is potential for gaps and moves and in either direction. I guess that would be the other way that I might try to take advantage. If I wanted to watch the last hour of the day, I can look for ones that have gap potential. So that might open much higher, not necessarily much higher, but even a little bit higher the next day, or open a little bit lower the next day, but with a gap. And that way I could just have an overnight trade. And with options, it would leverage that difference. So even if it's 0.5%, then with my options, that becomes between 2 and 10%. And that can be, it's not like super exciting money, but it's still profits. And if I accumulate that over 5 days, it can be pretty significant profits. So that's the other opportunity that we have this week, because the potential for gapping is much greater this week and next week. Okay, guys, so that's it for this morning. We'll just see how the day develops if we stay in that tight range, and then I'll see you guys in the aftermarket.